Hi, welcome to the Loan Officer Training Series with the Mortgage Calculator. We will wait just a few minutes to get started here. Everybody hang tight. Let us go live on all the different platforms. We are streaming live on YouTube, Facebook, Instagram, and LinkedIn. So give us a second to go live on all the different platforms. We did put the chat up on the screen in the meantime. If you want to go ahead and drop a comment there. I see some people were already dropping comments. Thank you for tuning in early. Just give us a moment and we will get into it. Today, we're going to be going through what is essentially a part two of what we did yesterday. If you didn't have a chance to check it out, you can go ahead and go back on our YouTube channel to check that out. Just give us a few minutes here. Thank you, everyone, for tuning in and commenting. Shout out to everybody in the comments: Julio, Roger, Grisita, Amanda, Pearl, Nicole, Ben, Oscar, Robert. Thank you, everybody, for commenting. We will get started in just a moment. All right, looks like we are live on all the different platforms. So let's go ahead and get into it. We can take the chat off the screen there. And then we can get into our presentation here for today. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey. We do this loan officer training series every Tuesday and Wednesday night at 7 p.m. Eastern, where we go through some different topics. And today's topic is going to be Freddie Mac guidelines. Now, yesterday we did the Fannie Mae guidelines. Today we're going to do Freddie Mac. In between these two guidelines here, that's going to determine if we're going to take the loan the conventional route, which is something that we're going to be doing every day now here at the Mortgage Calculator. We specialize in non-QM loans, but as we went over yesterday, you not only do we do conventional loans as well, but even to do non-QM loans, you need to know whether it fits conventional first or not, and why it wouldn't fit conventional in order to even know if you need to go into the non-QM programs that we specialize in. So I'm going to go ahead and turn it over to Nick here so we can get started. I know he has the Freddie Mac guidelines pulled up. We're going to keep it relatively short today. We're not going to go through a ton of guidelines, but we're definitely going to talk about some of the differences and why you may go Freddie Mac instead of Fannie Mae. A lot of things are very similar, but there are some differences there. So you can go ahead and pull that up there, Nick.
Okay. All right, let me send the link to everybody. I don't need to show it. All right. So hopefully everybody can follow along. Just like yesterday, you have to read every word of this to be a loan officer. So make sure you guys have this saved everywhere. And you're always referring to the guide. So to actually get the guide, you want to click on Browse Guide. Let's see if we can make it bigger.
Do you want to put us on the right-hand side of the screen, Nick? I think yesterday it was a much better view when we were on the right-hand side as opposed to below. Yeah, I think that's a better view
Hmm. So this is the guide here. It's a little bit different. Of course, you can always just search, just like anything, for example, rental income. So if we need to find a specific topic, just like Fannie Mae, we're going to find that specific chapter and read through it. So let's just go back to the full thing. You can also sort by chapter here and or series, I guess. Origination, eligibility. Here's some stuff. credit. Here's some stuff. So that's a quick way to skip through chapters. And all right, let's go through it here. None of this is for us. Gotta get to the actual origination part. Right here is probably where we would start. So here's some stuff that we'll have to check out. The loan purpose, refinance. Here's some of their specialty ones. Some other specialty ones. Some other specialty ones. Purchases. Arms. Converted. Land contract. All this stuff. Blah, blah, blah. Affordables. Heritage 1, more special. Construction to perm, super conforming. Home 1, green choice, renovation. And here we have our insurance requirements for mortgage insurance, title insurance, property insurance. And the one that you'll probably use the most is the origination chapters here. So LP, got to know how to use LP. Make sure you know how to use that. Make sure you know how to read LP.
Just real quick for the beginners too, remember LP is the Freddie Mac version of DU, right? We call the automated underwriting system for Fannie Mae DU, even though it's technically called DO, desktop originator. And then Freddie Mac is LP, loan prospector. So that is, the automated underwriting system for Freddie Mac is LP.
All right, and special stuff. There's where you can get all your special stuff. Credit, again, LP does all that, so you just got to read LP, credit reports, blah, blah, blah. Income, something we go to a lot. Make sure you read all the income stuff. Self-employed income, this is one that's different. You got to read this, definitely, because they treat the income differently. So make sure you read all the differences here in Fannie and Freddie. These chapters are slightly different. So make sure if you're reading one, you use the right one for each. They're all going to go through in detail here. How do I get back? Shoot. Oh man, it won't put me all the way back. Alright, now we're back here in eligibilities. Credit, where are we at? Self-employed. So yeah, you got to check out the differences there between Freddie and Fannie. They work very different. And rental income is basically the same, but they use different forms. So make sure you use the proper form for each. And obligations is different. Make sure you read all the obligations and make sure that this is really the only difference here. So make sure you understand the difference here on Freddie Mac for the student loans. So that's the big difference there. And man, it keeps putting us back in the full list. And To income, all right, assets, so everything's there. Property, the ACE, that's if it's appraisal waiver. So you got to read that for your appraisal waiver stuff. Let's see, appraisal reports, requirements. Properties, so just like the Fannie Mae, you got to read all these about what's ineligible, what makes non-warrantable, how to do all the reviews, all that kind of stuff, what you need for PUDs, what you need for manufactured. And yeah, we don't need to know any of these things. Yeah, all the servicing and delivery. So that's basically it. There's those couple chapters that are different, but remember, you got to read this whole entire guide, start to finish, to make sure you understand everything, and you can come back here and search it. So this is where the money's at, the 5,000 chapters here. We have any questions on this stuff, Kyle?
No, I know some of the key differences though are the student loans, right? That's a
Mm-hmm.
difference. Also, Freddie Mac can allow 1 year tax return, right? Do you want to touch on that?
Yeah, we pulled that up in the self-employment. You got to read the whole thing though. So if you go to the self-employment, it tells you all the info on that. So we went over that. That's 5. It's this one.
Mhm.
So you got to read all the info here, but again, it's all going to be on LP, right? So you have to run LP and you have to read LP, and then LP will tell you exactly what you can and can't do. So it's going to be a little bit vague here, because it's all based on LP. So you got to run the LP, and the only difference here, I can't, it's too zoomed in, I can't read it. So yeah, I don't know if they're listing it. You just got to read the DU. It's going to tell you exactly what to put here.
But it is possible to get a 1 year tax return.
It's required for 5 years, but they don't list it here. I can't see it. Yeah, greater than. So, but I mean, you have to read the LP because you can't do anything without the LP. So it doesn't matter. This is only LP. So this is only if you get LP. Is it? So it's only on LP. So you can't. It's if it's greater than 5 years, it's just the most recent year, but you have to put that into LP and it has to be accept. Otherwise, you can't use it, right? So this is only if LP says it. So again, you just got to read LP. It will say this if you put it in correct, but only if it's accept. You can't do like a manual underwrite and do this. So that's kind of where they're telling you. Uh, in the same business. Yeah, so this is the fine print here. So this is really where they differ. There is DU will tell you on its own, and LP says that if you have it greater than 5 years, it's going to automatically do this. But again, you have to get it right. It's only streamlined, except meaning you have the LP result. So if you run LP successfully and you get a success, it will always say this. Whereas DU, it doesn't tell you if or when or how it will say that. It will just make up its own mind. So both of them, you have to read it, really, at the end of the day.
Okay. I know Freddie also has an option to use asset utilization essentially for certain borrowers of a certain age, I recall.
I don't know if we can find that.
This is why we need Jose here because he just is off the top of his head
Well, I know the how
knows
to
these
do,
things.
I know how to do it, but I don't know which rule it is here. Um, Man, why doesn't it go? Why?
Yeah. It's okay. I think we can just talk about it if you can just touch on it real quick on how it works.
I'd have to find it to touch on it. So let's see if we can find it here. Where's the income? Oh, assets as a basis. Yeah, here's the chapter. All right. So they use 240. So they use 240 and they use retirement assets or a different type of retirement or depository accounts as securities if the borrower is 62, or from sale of business. I guess this isn't 62, so this is the only one where they don't have to be retire age. But
But
yeah,
essentially, the opportunity here is that if they're at retirement age, you can use their assets, those assets that are listed there, the acceptable types, to determine income. And what'd you say? It's based on 240, you said?
yeah, it's hard. You got to jump through all these hoops. Um, but it's cool because you can add it as additional income. So if you find it, most of it's just going to be retirement assets. So you're just going to need the statement, and the assets are met. So they're not already being used. They're the sole owner of it. They must have access to withdraw it or any other encumbrances if there's some sort of penalty or whatever. Um, and yes, it is 240. The amount of net eligible assets is calculated by subtracting from the total any funds to complete the transaction, so down payment, closing costs, any gift funds or borrowed funds. So you gotta like back out anything you're getting for free there, and then any portions that are otherwise encumbered. So sometimes people like take a advance on their stuff. So anything beyond that, you just simply divide by 240 and you get a little bit of extra income. So this is like a super great way to get a little bit of extra income, but it's usually only typically works out for people that are of retirement age, typically, I believe, for this one.
So especially if you have a retirement age borrower, you're over there running DU, you can't get enough income, and you haven't even thought to switch over to LP to see Freddie Mac, you could grab the extra income you need possibly right there just because they have in a retirement account, right?
Mm-hmm.
It might not even be that much in the retirement account, but it might be just enough to fix your DTI, right? So
Yeah, divided by
great, great
240 is a
strategy.
pretty big chunk, right? That's taking it over 20 years, but it makes a difference, right? If you just need a little bit. There is a let's see. There is a Fannie Mae version. Let's see if we can find it. Aha. Other sources of income. There's the asset depletion. Which chapter is that in? Says it's in here, but where is it at? Don't see it listed as a chapter. Where do they have it? Depletion. Ah. So it's listed in here. It's just not said depletion. Let's see where the word assets is.
Yeah, quite a few there.
Yeah, I'm trying to find the one with their. I think it's a 360. 360 right here. So this is a chapter. So they did. It's the same thing, right? We're saying we're going to use an IRA. Where they got a cool example here, right, guys? Same example that Freddie would use. Uh, Minus the penalty for early withdrawal equals how much we actually have, minus required cost for closing. So say they need 100,000 for down payment, closing cost reserves. So they have this to actually use, and then their calculation is divided by 360. So that's what I wanted to find was the 360. And all of the following must be met in order to use employment related assets as income for for Fannie here. So this is usually what hits us, right? So this is why we rarely can use it. Has to be 80 LTV or lower, and the owner of the assets has to be 62 years of age. Now, at 70, they don't have to be 62. So that's where these differ as well. So you got to check out there's a whole bunch of little supplemental guidelines for this. So make sure you read every word of this if you're going to try to go for it. Remember, it's not just A or B, it's all of it together. And same thing with Fannie here. It says all. So remember, we were talking yesterday about and or. All means boom. So there's two options here. So it's this or this, right? And you're still under all. And then it's this, and then it's this, and then it's this, and then it's this, right? So, actually, the income is by the mortgage loan. So 360 is just because we always do 360. So I guess technically, if you did a 15-year with Fannie here, the calculation actually changes. So this is good to know. Most people say it's 360 because 90% of loans are 30-year loans, but that's good
So,
to know.
so if we would have read the top part and said, yes, income, assets is income, right? We're in
Mm-hmm.
the business, but we didn't scroll down and see it doesn't help us unless we're at 70% LTV or 80% LTV.
Correct.
That's a
Yep.
huge
So you got to
difference
read that
there.
whole part, and then you got to go through here, and then you're good to go. So yeah, it's only on principal for primary and second homes, and it's only purchase and limited cash out, not for cash out. So you got to be careful there, but it does help when it helps. A little bit less strict, I think, on the Freddie in general, but I mean, you got to read it, but it has to be 1 or 2 unit primary or second home. Has to be a purchase or no cash out. So same thing, same rules here. Minimum LTV or maximum has to be 80 or less. So They just say 80 or less, period. They don't say the 70 mark or whatever. And then they say 240. And then they have some. So retirement ones you see here have the doesn't say you have to be 62 here for Freddie necessarily. For these types, you do. Which one was it? This one, the depository accounts and securities. So this is just like general bank statements, right? If you're going to just use general bank statements, you're going to have to be 62 years. But I believe what it's saying here is if you're just using a 401k, you can use it without having the age as long as you can document the penalty of withdrawal or whatever. So just read through all this and make sure that it applies. But this is how we get a little extra juice from either of the guidelines. Is there any other ones to go over on the differences here, Kyle?
Not that I can think of off the top of my head, but just remember there's two things to run, right? You can run DU, you can run LP, you can look in the guidelines, excuse me, look in the guidelines on both of them, and then you can venture into other programs and non-QM. So you're not just going to go straight to non-QM just because it doesn't quite fit Fannie guidelines, right? We can still do a conventional loan and get much better rates in terms, of course, conventional is always going to be better than non-QM programs, a cheaper option for the borrower, which is our job, right? To present always the best option to the borrower. So we don't want to be those people who skip right to stuff, right? We're going to do our proper analysis. Does it fit Fannie Mae guidelines? Does it fit Freddie Mac guidelines? Can we do it as an FHA loan, right? And when all those options are exhausted, that's when we're going to put our non-QM hat on, which is where we shine at the mortgage calculator, and we're going to still make it happen. But we need to know what we can and can't do, and the only way to do that is run DU and LP and check the Fannie and Freddie guidelines.
So there's some form databases here that I just wanted to go over because they have a nice tab here. None of these are really the forms that you want that are useful for you guys. These are more like delivery forms and stuff. So now that Kyle mentions it, let me pull up one more tab and let me copy it so I can save it for everybody. So the tools that I love to use for all the guidelines are these ones from our partners at Enact. We use them for our mortgage insurance, so this is great. But they have free tools for us. So we want to read all the guidelines, of course, make sure we're following the guides. But these tools are great tools to get us headed in the right direction, depending on which one we're going to do. So Fannie Mae has their own form. So if you read the guidelines, it'll say 1084. So remember, that's the version of the cash flow analysis for self-employed that we have to fill out. There's a version that Fannie has, or a guide that they have basically, but our Enact partners here have already made one for us. So this thing is awesome. It's a great form. We link to this in all our training guides, so I'm sure those on our team are familiar, but for anybody out there, it's a great resource where they've already done all the math for you. They tell you exactly what line is supposed to go where, which lines are a plus, which lines are a negative, which lines are non-deductible, which lines are deductible, which what the actual depreciation rate is for mileage for each year, so you don't have to do those all manually. So please use these forms where everything that we read here, especially for like this example where we went over the these very specific type of guidelines, those are already programmed here. So this one is the Fannie Mae 1084, right? And this is their PDF version. This is the version I suggest. They have the 1084 Excel. I'll open that for y'all real quick. So this is that one. A little more complicated, but it adds up everything. So does the PDF form, adds up everything as well. So, but if you like spreadsheets, if you're a spreadsheet person, maybe this is for you. It's the same formulas, right? It's going to have the same lines added, the same lines subtracted, as long as you go through the return with all that info. And the one that I prefer, and we just went over, is Freddie Mac. I like their forms. They are simpler. Fannie has like everything in one. Freddie Mac has a Form 91, which is for self-employment income. They have a Form 92, which is for Schedule E net rental, right? So I like how they separate it out. So I definitely suggest most people start with the Form 91. It's a little bit easier. It is going to be specific to Freddie Mac, but their general guidelines are the same overall. There is a slight variation though. So make sure if you are going to submit to Fannie, you use a Fannie form. But I always recommend most people start with this one, a little easier, a little more straightforward. And that way you can split your rental income from your self-employment income, which makes it a little easier to input on your 1003. So these are great guides. Definitely recommend them. That was a 91, right? Yeah, this is the Form 91. The Form 92 is for rental properties. So read the guide on either or. And this is going to be the spot where you put net rental from subject. So if you're purchasing a primary residence 2 to 4 unit, net rental income from Schedule E if the subject's an investment property. So if you're refinancing or whatever, an investment property that's already on your Schedule E, or net rental income from Schedule E for non-subjects. So this is where you get a bunch, right? So some of our investors with 10, 20, 100 properties, we're going to have 5 or 10 of these sheets with 3, 4, 5, 6 rentals on each sheet, right? And then this will tell us the amounts we type into the 1003. So please use these forms. There are other forms as well to help you with other things, right? If you're reading through the guidelines and you need a current ratio liquidity calculator in order to find out if you can use a P&L or something from a business, right? Read those guidelines, it'll tell you. And thankfully, you don't have to go make that up. They already have this for you. So when it says we need a liquidity calculator, don't panic. Enact already has that for you.
By the way, we also have trainings in our training center. We have videos of actually filling out both of those calculators, all of those calculators
Mhm.
that we went through. So for our team in the training center in the loan video library, we have videos of literally going through a tax return and translating it into the calculator and adding up the income for those calculators he just pulled up.
Mhm. And this one is great too. Definitely recommend this one. Let's pull this one, just a general income. This one's more of a, there we go. This one's for a wages, right? So we're gonna have W2 from year 1, W2 from year 2, year to date, per hour, number of hours. And I love these because guess what? It's gonna pop out the number that you use, right? You put in the inputs, it's gonna tell you the output. You don't have to do any fancy math or any thinking of what's greater than what, or reading the guidelines, which you still need to read, right? We're still gonna want to where the hell are the guidelines at here? There they are. They're hiding behind. Split screen these with these. Here we go. So if you're reading through the guidelines and you find how you're calculating income, and it tells you must use, see the averages of W-2s and all this, this thing does all the math for you. So make sure you understand when you're reading through and saying, oh, I have a little tricky income here. If you need overtimes and bonus, this is where this really comes in handy, right? Because overtime and bonus has a whole other overlay of rules once you read through the overtime and bonuses. Please read through that. Obviously, since we have plenty of time, I'll just real quick go to overtime and you'll see what I mean. Overtime. So we have a whole chapter here of how to do the overtime, right? It's going to tell you to do this, do that, do this, do that. And you basically got to read through this, but have this pulled up at the same time you're doing this, and it does all the math for you. Just make sure you have the right inputs. So I really love this calculator. Definitely all of our files that have this in them. Much easier for us all to see when we have a nice calculator in the file, even for just base hourly wages and stuff. Some people do the calculations easier than others. This makes it easy where everybody can see it instantly. Nobody's guessing.
All right. Great. So again, slight differences between Fannie and Freddie. The guidelines are always at your fingertips. DU and LP are going to give you a great idea, but you got to read the findings once you run DU and LP, and you got to check the guidelines, especially when you have specific things going on. So
Remember,
all the power.
the findings will reference the chapters, right? So it becomes easy when you have the chapters there. It says it'll say you're approved pending blah blah blah, and then it'll say please read chapter 50232 whatever it is, and then just note that just because you read the one sentence that said you're approved based on what you have, you still got to follow all the ands, the ors, the alls steps of that chapter. So when they link to that little thing that says check the chapter, please check the chapter, right? Because just because you typed something in your 1003 doesn't mean that you check all the boxes or the or boxes where it's only one or the other and you have to be one or the other. You can't be both, or the and where you have to be both, right? Remember to go through all those little kind of synaptic things there. Make sure everything lines up because DU's only or LP is only as smart as what you put in there. That's why they always say, and make sure it follows the rest of chapter XYZ, right?
And the moral of the story here for both of the trainings, both yesterday and today, the Fannie Mae and Freddie Mac guidelines, is that you have the power at your fingertips, right? That's what, when we tell the story about Nick, when we first started working with the bank, it's once he found the guidelines and the selling guide, he was empowered, right? He loved it. He said, I love this. I have the power now. I'm empowered to be able to, fit things to the guidelines to know what I can do and can't do. So once you really embrace that, it's very empowering to know this is what I can do, this is what I can't do, this is where I can look up what I can and I can't do, and I don't have to ask anybody, I don't have to wait for anything. I have the power at my fingertips. That was Nick's biggest thing is there's nobody to ask, there's no documents to use, there's nobody in charge when we first started working with a bank, and that changed the game for him. He found out that he has the power right there, and he doesn't need to talk to anyone. He can talk to the real person. The real person, the decision maker, is the guidelines, right? That's
Or a person named Fannie Mae and Freddie Mac. It sounds like people, right? Those are the
yeah,
decision makers there. So uh, the one thing, though, again, you have to know what you have to know what you don't have, right? So if we can't fit in here, that's when we go non-QM, and that's why we obviously can't make our business work at a bank because banks can't use non-QM. So we quickly found that there is stuff that doesn't fit in either box, right? And that's where non-QM comes in. But first, we got to check both boxes, and then we have the whole wide world of non-QM at our fingers as well that basically allow us to break any of the rules that you see here. So every rule that you see for QM, every rule you see on Freddie Mac, every rule you see on Fannie Mae, there's a non-QM program that's specifically made to break that rule, right? That's why non-QM exists. They're saying, okay, in general, these are great rules, but some people have a foreclosure, right? We can't wait. Everybody can't wait 7 years on a foreclosure. There's some investor, some bank, somebody that has money that says, hey, people need a second chance. We're going to charge them more for that second chance. But there's a plethora of programs that attack that specific guideline that says you can't have a foreclosure. We have plenty of non-QM loans that do allow us to have a foreclosure. Obviously, they cost more, have different guidelines that make you jump through extra hoops. You might have to have better credit, right, to do those types of things. Obviously, you've had to improve your situation, all those kinds of great things. So remember, you got to check out what you have to see what you don't have, and then you can open up the whole world of non-QM. And remember, if there's something specific you're not qualifying for, there's probably a non-QM program specifically for that person because they literally exist to break 1, 2, 5, 10 of those rules that you're looking at, right? And every non-QM has a different combo of 1, 2, 5, 10 rules that they're breaking in order to make something unique and special that people can take advantage of. So hopefully that's helpful.
perfect. Okay, well, thank you everyone for tuning in. Remember, we do this every Tuesday and Wednesday night, 7 p.m. Eastern, so you can tune in. Appreciate everybody hanging out with us tonight and last night, going through the guidelines. And we hope to see you all next week, Tuesday and Wednesday, 7 p.m. Eastern Time. Thank you for tuning in, and we hope to see you on the next Loan Officer Training Series with the Mortgage Calculator.
Thanks, everybody.